Anybody there calling out to the audience?
Yes, we're here. We're
Yeah,
doing great.
we got you.
All right, we got to make this interactive. It's early on the East Coast, but I want to make sure that this resonates with you guys. So if you can, turn on your cameras. If you don't mind engaging, this is hopefully interactive. The conversation is supposed to be hopefully beneficial, but the only way I can do that is to tailor it to you guys. And I need a little bit of feedback along the way. So, unmuting yourself, turning on your camera, engaging, that's where I think we're going to get the most benefits here. So we're talking a little bit about finances today, but along with that, about how to raise capital and how to manage that capital, right? How do you think about your finances as it pertains to raising money, as it pertains to your startup, right? So we're going to talk a little bit about venture capital. We're going to talk a little bit about how to present your company and tell the story of your company and the finances of your company to venture capitalists. As just to level set, right? Venture capitalists come in lots of different flavors and sectors, right? And you don't have to take venture capital money to build a strong business, right? If you're building a solid business, you can do so with grants. You can do so with bootstrapping it, but venture capital allows you to go a little bit faster. Right. But when you're talking to VCs, know that the VCs have very specific specialities, right? The type of investments that they make are really based off of the stage of company, the industry that they're in, or the geography that the company might be in, right? So anytime you're talking to a VC, make sure that all three of these things match up, that they will invest in your geography, in the type of business that you're in, and at the stage that you're in today. From what I understand, you guys are primarily a pre-revenue, but the few of you guys, actually maybe a little bit of mix, half and half are pre-revenue, half are post-revenue. Has anybody raised capital here yet as to so far?
No, not yet for me.
Not yet for us.
And how many of you guys want, and do you guys have the ambition of raising capital, of raising venture capital?
Well, obviously, yeah.
You say obviously. My first company I bootstrapped and was acqui-hired. My second company I raised venture capital for, and it's a great way, a great tool, but know that it comes with a lot of expectations. Venture capital means that you have to build a big company. You have to have big aspirations, and you have to grow really, really fast. The big aspirations piece is really the thing that people have a hard time understanding. Every single VC I know is chasing a unicorn. And sometimes not even unicorns anymore. Sometimes now they're chasing decacorns. And that's because 60% of venture capital returns are made up of 6% of the deals that they invest in. So that means that 6 out of 100 companies that a VC invests in makes the majority of their value back, their returns. So it's all the unicorns that make them all the profit, and everybody else is just an afterthought. So if you are talking to a VC and you aren't planning to build a billion-dollar company, then you might have a hard time raising venture capital dollars. That's just one thing to understand as you're thinking about the company. And we'll talk a little bit about how do we make sure that we're going to build a big company? How do we make sure that we can build a big company? What are the ways that we can think about it? We'll talk a little bit about that in a few slides. But if you haven't raised any capital, there's a couple of different stages to come in at to raise money, right? You guys are in an incubator, accelerator right now. Sometimes accelerators, include some cash. Sometimes you're able to raise some capital going into an accelerator. Then once you are able to prove a little bit more, then you can raise a pre-seed round, a seed round, your series A, B, and C. Today, we're really going to talk about the pre-seed round and your seed rounds. Those are the areas that we're going to be mostly focusing on from a fundraise perspective. Now, I say this is a mixture about how to raise money, but also how to build your finances, how to think about your finances. And that's because the financial plan of your company is what's going to drive most of how you communicate to investors, right? If you look at this agenda slide right here, this is how you build a pitch deck, right? If you think about most investor pitch decks, you have to have a problem, a solution, a team slide, a competition slide, but then you have to have a slide about the business model, a slide about the size of the market, a slide to talk about how you're going to use the money, your projections or your milestones, your traction, your unit economics. All of those things come from your financial plan, right? And so it's very, very important to put your thoughts together on paper and make sure that you have your thoughts fully fleshed out to be able to communicate to investors effectively. All right, so what I'm going to do is talk a little bit about each of these slides and then talk to you about how to think about your finances, how to derive the data behind these slides. All right, so the first one is thinking about your business model, your go-to-market. How do you make money? So the first thing about how do you make money is to break it down into chunks that make sense. A lot of people want to talk about estimated revenue, but they don't explain how they're going to make money. They don't explain the size of their customers, right? And so the thing that I guide people to is break your revenue into customers times price. Right. And so you say, here's the average customer, how much the average customer pays me. And here's how many customers we are going to get each month, or we're going to expect to get. Right. When you multiply those two things out, that gives a lot more detail for an investor to really understand what's going on. Right. My favorite example in this is Airbnb. Right. With Airbnb, this is their Series A deck. This is how they communicated to investors in their Series A, right? And they said, hey, we're going to make $10 million this year or next year. That's based off of, I'm sorry, we're going to have 10 million trips. With each trip, we're going to make an average of $20, and that's going to make up $200 million in revenue. Right. And so they said the average customer, they make $20 off of. To get that $20, they looked at 3 nights at $70 a night, and they make a 10% commission. It's so simple and elegant, but explains so much, right? It tells everything about their business right here in this one slide, right? And once you figure out your customers times your revenue, that's the same equation that you're going to use to explain the market size, right? If an investor asks you, how big is your market? Then you'd want to talk about the average revenue times the entire spectrum of potential customers. And that's your total addressable market. There's an example from a company called Covey that is a ride hailing or a car rental company. And they said there's 3 million potential drivers. 70% of those are potential renters from us, and we make $5,000 a year from renting out to potential drivers. And so that by breaking that down, they came up with a $10 billion market opportunity. Makes it really straightforward. Any questions so
far? Not yet.
Yeah. I thought Tuso would speak about this, because I think Tuso has actually raised money. And I don't know if we call that bootstrapping, but maybe Tuso, you want to comment there?
Well, I think let me just take it through, because apparently we just discussed like the same thing right now, me and Zeno. So I think this is going to be a building block to what we are trying to put together.
Okay, well, I'll keep going. And if you, again, as you think of questions, please interject, right? So then the next thing that you want to be able to communicate to raise money is to talk about how much money you need to raise, right? And I always say lead with how much you're going to raise, but make sure to talk about what you're going to achieve with that, right? So a really good example is Substack. When they were raising their seed round, they said, hey, we want to raise another $1 million to go big. That means that we're going to hire developers and use some of that money to pay high profile writers. And that's going to take us to $5 million in ARR, right? And so in this one slide, they said, we're raising $1 million. Here's where we're going to use the money for developers and hiring writers. And we're going to get to $5 million. It's really straightforward, really simple, but it explains so much. So the next thing that I want to make sure that everybody thinks about is when you think about raising money, making sure that you are raising enough capital to be able to get to the next round. When you build your model, you want to be able to make sure that you go from where you are today to be able to raise the next round of funding, right? A lot of people think that this is the only capital they're going to raise, that they're going to be cash flow positive. And that's nice to think about. But even if you are going to be cash flow positive, just make sure that you can get to that next milestone, and don't expect that next milestone is just going to come easily. You need to make sure that you are able to get to a meaningful place in your business, right? And so I'm going to talk a little bit about each stage and what it means to raise each type of capital. The first one is pre-seed, right? To build a pre-seed, to get a pre-seed round, we're talking about a small sum of money, right? In the US, that means a couple $100,000. I'm guessing in Africa, it might be a little bit less, but that goes a long way to get you started. That goes a long way to get you started. To do that, you just need to be able to demonstrate a good MVP, minimal viable product. It just to give a, sorry, I have a little one with me this morning. Just to give investors the idea of what you're about to build. And the best thing that you can do is explain why you are the team that's best suited to solve this problem. Now, to raise a little bit more capital, to raise seed capital, what you need to do is prove product market fit. That means that you have to show that what you're building, that you've built something, and that you've built something that people love, right? And building a product that people love means that you either have revenue, right? If people are willing to pay you for your software, then that means they probably like what you've built. But if you don't have revenue, then you have to show that you have users that love your product. Even if they're not paying you, they at least are ranting and raving about your product, right? And then usually it's, a couple $100,000 of annualized revenue to raise a seed round. Now, make sure when you raise a seed round, you're able to take that all the way to get to your Series A. And your Series A means that you have a proven revenue model, right? That means that you've reached a little bit of scale with your revenue. That means to get to at least $1 million, usually a couple $1 million of annualized revenue. And that means that you have a recurring type of customer, a very specific, repeatable type of customer that buys your product for a very specific, repeatable way, right? If you have one customer that is, a retailer, and it's the CMO that buys your product, and then you have another customer that's a shopkeeper that is, the owner of the shop that buys your product, and every other customer that you have looks a little bit different, then it's not repeatable. It's not proven. You have to create kind of that repeatable engine to be able to raise that Series A. And then again, the big thing that I mentioned at the beginning is that venture capital means high growth, fast growth, big market opportunity, and fast growth. And fast growth means that you're growing at least 3x every year. That's what's going to get people, investors, very excited. If you can't grow 3x in the early stages, then you're going to have a hard time getting investors excited. Now, if you tell investors you're going to grow 10x every year, then it may not be realistic. It may not feel real to investors. But if you say you're only going to grow 50% every year, then investors may not get excited about you, right? Now, my best rule of thumb is called triple, triple, double, 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 right? The first couple of years you want to triple, and then every year from there on out, you want to double each year after that, because growth gets harder as you get bigger numbers. Now, the other thing that you want to be able to show, other than revenue, is to be able to show good unit economics, good metrics, right? If you don't have revenue, in your company, there are ways that you can, in pre-seed, talk a little bit about how much people love you, right? That can come in the number of signups that you have. That could be the size of your wait list. It could be satisfaction surveys, net promoter scores. You want to be able to maybe, the utilization of beta users on your app, right? Are they in there every day? Are they in there every week, every month? And what is the repeatability of your customers, right? Those types of things help show that people like what you do without actually having revenue. Now, once you have some revenue, again, growth is the #1 thing that investors want to look at, which starts with month-over-month growth, right? How much growth how much are you growing in terms of customers? How much are you growing in terms of dollars? Past that, the next most important thing, other than growth, and that feeds into growth, is retention. How much do customers love you? Are they happy? Are they satisfied with you? Or are they dissatisfied with what you're providing so far, right? If you have a leaky bucket, if you have a lot of churn, it's going to be hard to grow fast. And that's why retention is the second most important thing that investors look at. And then in the presentation here, I'll have other benchmarks that are important. Your net promoter score. You want to make sure that you have above a 50 net promoter score, or above a 40% product market fit survey. Your gross margins. You want to make sure that you have a high margin business, and that you will have, again, a net retention, right, of over 100%, a gross retention of over 80%, and a net retention of over 100%. Net retention means that if you lose a dollar from a customer, that one of your existing customers pays you at least $1 more each year, so that without any new customers, your company doesn't shrink. Now, to think about your finances, your financial model, that needs to evolve and grow over time as well, right? And so it starts with, early on, you just need to make sure that you keep track of how much money you have in the bank and how much you're burning each month. That can be done in one simple page that says, each month I'm paying this much for each employee. I'm paying this much for the following types of software or the following expenses. And here's how much money, and here's when we expect to make money. And then here's my cash balance at the beginning of the month, my cash balance at the end of the month. And that is all you need early on. But as you get more advanced, as you get a little bit further out, you want to be able to say, here is my revenue, right? And remember, the revenue, it's not how much total revenue I have. You want to be able to say, here are the number of customers that we're going to get each month, and here's how much they pay me on average, right? So you have a detail of customers times price. And you also want to, at this point, have detailed expenses. You want to be able to explain the drivers that drive your costs, to be able to say, when I achieve, when I sell one customer, here's everything that I have to spend in order to make that, to keep that customer, right? That COGS, that shows that you have a high margin business. So as soon as you have customers, you need to be able to be very thorough in your COGS and show how your margins at least stay stable over time, if not improve over time. And then when you raise your Series A, the next round, now at that point, you have to be able to explain how you get your customers, right? It's not enough to say, have this many customers and they're going to pay me this much. You're going to say, I get my for every salesperson I hire, that salesperson brings this many customers each month. Or for every dollar in marketing I spend, I get this many customers. Or for every radio advertisement I play, I get this many customers, right? So you have to be able to explain how you're going to keep growing the machine. How is it repeatable, right? That's what I mean by repeatable revenue model. That's what you need to be able to show by your Series A. Any questions?
I'm good so far.
Okay. Well, you know, with that, I'll just mention a couple of things, right? So this is intended to be a kind of a high level intro, right? The reason we give this workshop is because FINMARK provides financial planning software for companies. So if you are interested in checking out FINMARK, we'll share a special deal for you guys that you can email Julian and he'll give you a special deal off of FINMARK. But we also try very hard to be a lot more detailed in our education series, right? So this was a high level intro, but as you think about the more detailed information about, hey, what employees do I need to hire? How do I think about the different types of revenue? What metrics matter for my business? We have a very extensive resources section on our blog that will help you think through those. And so I encourage you guys to check it out. But that's the end of my intro to kind of fundraising and finance.
Is it
Right,
possible
cool.
to get these slides when we're done?
Oh yeah, absolutely. I think we'll share the slides and we're happy to send over the recording.
Oh, that would be awesome. Thank you.
Awesome. Well, guys, so nice to meet you this morning. I know it's a little bit later in the afternoon for you. Hopefully I'll see you guys in FINMARK.
Yeah, thanks a lot. Thanks a lot,
Okay,
Rami. I mean, this was really awesome. I'll allow the team to go through the slides just to appreciate the content. Then if there's a need for a deep dive, I guess we'll organize. But the idea, guys, was just to let you know how you actually win with VC raising money, right? And obviously you understand the type of companies you're building are not like, your brick and mortar or somebody selling alcohol. So these type of businesses will require a specific type of finance, which is a VC capital or angel finance. So I think this tool from FINMARK, for my view, would assist you to be able to get quickly, in terms of your fundraising milestones. So I think feel free to ask any questions now, if you have any, such that we can make use of this opportunity that we have. So I think let me open it up for you guys. If you have any questions for Rami or the team, feel free to ask anything that you wish to ask, depending on the stage of your business, of course.
Well, I'm actually still kind of good for now. I got only one last request. Can I see the last slide one more time?
Sure thing. Let me get that shared. boop, boop.